So, Federal Reserve Chair Jerome Powell just delivered what will probably be his last address from Jackson Hole, which is the big global meeting of central bankers, which takes place in Wyoming every year. And he signaled that he's probably going to cut interest rates. But what really interested me about what he had to say was this moment.
In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate.
So the Fed has two jobs. One is to keep unemployment as low as possible, and the second one is to keep inflation under control. Those are the two pillars of a strong economy. Low unemployment, lots of jobs. You can get a job if you want a job, and your money's worth something. The money you earn from that job is worth something. Now, what Powell was describing in that moment is what happens when those two things are at odds. Because right now we have both an economy that seems to be slowing down, the growth is slowing a little bit, which threatens job creation, but also inflation has been ticking up. Now, in a situation like that, the Federal Reserve kind of has to pick its poison because if you take action to grow the economy to reduce unemployment, that really risks increasing inflation. And if you turn your attention to inflation and dealing with that, that is probably going to slow the economy down and raise unemployment. And here is why. So, when you cut interest rates, it makes it cheaper to borrow money. So, businesses and people borrow more money and then they spend more money and they buy more stuff. That means companies sell more stuff, which means they are making more money and they start expanding and investing in machinery and hiring people and giving people raises. And that grows the economy. It trickles out across the economy. So all of this is great, but there is also a downside. By cutting interest rates, that tends to increase inflation. Because when you cut interest rates and people start borrowing more money, they have more money to spend. And that increases the demand for stuff to spend it on. That increases demand. And so if you're selling something, you will increase your prices. And then prices start going up, and that can boost inflation. Essentially, what Jerome Powell seems to be saying here is that he is open to or planning on cutting interest rates a little bit in order to help the job market. But he also knows that by doing that, it could increase inflation. In other words, the two jobs that he has are at odds. By fixing one, you risk making the other one worse. But that is the situation our economy is in right now. So Powell is looking at the dual mandates, and he has picked which one he wants to address right now, and that is jobs.